All right, great. So let's get to it. Let me formally introduce Thomas Barkin. Tom Barkin is President and Chief Executive Officer of the Federal Reserve Bank of Richmond. In this role, he was responsible for monetary policy, bank supervision, payment services, and the Fed's national IT organization. He serves on the Fed's chief monetary policy body, the Federal Open Market Committee. He is on the ground continually in the Fed's fifth district, which covers South Carolina, North Carolina, Virginia, DC, West Virginia, and Maryland, and has brought a real focus to the less prosperous parts of the district. Tom joined the Richmond Fed in January of 2018. Before that time, he was a senior partner and chief financial officer at McKinsey & Company, a worldwide management consulting firm. He also oversaw McKinsey's offices in southern United States. Tom served on the board of directors for the Federal Reserve Bank of Atlanta from 2009 to 2014 and was the board's chairman from 2013 to 2014. He is a member of the Emory University Board of Trustees and the Greater Washington Partnership. Tom is a native of Tampa, Florida, and attended Harvard University, where he earned his undergraduate MBA and law degrees. So thank you for joining us, President Barkin, and I'll throw it to you.
Thanks, and call me Tom. Well, I guess first of all, welcome to my house. I don't know if you can see it in the background, the bookshelves in my office, and we're busily working at getting everything set up here for the new economy. I thought what I'd do to what Jamie said is just talk a little about what's happening in the economy, what the Fed's doing, and where I think it's likely to go from here. I'm probably at my best answering questions, so I won't take too long speaking at you, but I'm pretty open to anything that I'm allowed to talk about. I'm happy to talk about. So let me just start with, we're engaged as an economy in an effort to control a health crisis through social distancing. In this effort to control a health crisis through social distancing is having effects on multiple segments of our economy. As a 70% of our economy, 70% of our workforce are in the service sector, and large sectors of physical retail, travel, tourism, arts and entertainment, restaurants have been shut down. Concerns have grown, and governments have responded with shelter in place. And as a result, you see things like construction being affected, perhaps because it's not an essential industry. You see things like automotive and manufacturing being affected because demand's down, increased absenteeism. Separately, oil prices have plunged, in part due to demand issues, but in part due to an effort by the Saudis and the Russians to put pressure on prices. And oil exploration and drilling is suffering with $25 oil. You would think hospitals would be the safest place to go. Hospitals make all their money off of elective surgery. They don't make money off of elderly people with serious viruses. And the numbers I've seen is your big hospital chains are losing hundreds of millions of dollars a month in cash as they make their choices. Real estate firms are struggling because restaurants and retailers are pushing it upstream. And across the economy, you're seeing liquidity issues, cash flow issues as people struggle with where we are. And maybe just to sum it up, if you're in one of these industries and in a very legitimate effort to control a healthcare crisis, folks in government have somehow said, let's shut down these businesses, there's a lot of emotion there. And I think the politic of this country needs to understand there's just a lot of emotion if you talk to someone who's in a restaurant or a bar or a... Now, this has come on so fast that the data we get is basically obsolete. If you just looked at the data that comes through on a weekly basis, you'd say, hey, the economy's in pretty good shape, which is where it was in February. But the best place to look for real time is initial unemployment claims. 3 weeks ago, they were 211,000, where they'd been for about the prior couple of years. A week and a half ago, they were 3.3 million. So whatever that is, 15 times higher. Last week, they were 6.6 million. Just for reference, this series has been tracked since World War II. The most number of jobs lost in a week before 2 weeks ago was 695,000. That was in 1982. I was in college. So it's now 10 times more than the most ever in history, which is just a staggering number. And the potential downside here is almost unfathomable. Just to get your mind around it, there are about 12 million people who work in restaurants, another 11 million who work in physical retail, food and drug, another 5 million in travel and entertainment. So call that 30 million people. There are only 150 million people in the US workforce. So that's 20% of the US workforce right there. And I'm not including layoffs in construction or manufacturing or other functions. Forecasting is almost impossible in this scenario. But I think most people who look at it would suggest we're going to see unemployment 15% or higher. The highest it's ever been was about 10 or 11 since World War II. That you'll see GDP in the -20 or higher range, which would be the lowest it's been since the Great Depression. So the economy has decelerated at warp speed. And it's going to be very deep and not very pretty. So given these implications, you see real work in three places. And I would, just for context, I think of this as a lot like 9/11. I don't think of this like the financial crisis. In the financial crisis, you had the banks in real trouble. And the Fed, as the people who oversee the banks, had the first chair in that fight. This is a different fight. 9/11, it was terrorists. Today, it's a virus. That incident has shut large parts of the economy down. After 9/11, I think you had to get safety right, then you got fiscal right, then you got Fed policy right, and that's how I see it today. The first chair here is health policy. The second chair is fiscal policy. The third chair is Fed policy. Let me talk about each of them. Health policy. This is the most important. If people don't have confidence that they can leave their house and have their health, they're never going to leave their house. And if they don't leave their house, you're not going to have much of an economy. And so we need to do everything we can to get the health of Americans in a place where they can feel comfortable with it. That includes testing. I'm frankly was stunned 3 weeks ago when I found out we didn't have enough tests, right, for people to know who had the virus and who didn't. Social distancing, which we're doing, creating capacity in our hospitals, which includes beds, but also includes masks and ventilators and all the other stuff you need in a hospital. And then critically and importantly, some sense of a treatment. Just to give you context, in 2009, 60,000 Americans died of the swine flu, H1N1. I was in business at that time. I can barely remember it. The reason I can barely remember it is a minute after it got diagnosed, a big shipment showed up in our office with something called Tamiflu. And Tamiflu is a medicine that you can use to address it if you get the virus. And viruses are not that scary if you've got a treatment. They're just very scary if there's no treatment. And so the first thing we need to do is to get people tested and get some confidence in a treatment. And that's absolutely critical. And anything we can do to pour more money and pour more resources into getting our hospitals and our doctors capable is the first chair. The second chair is fiscal policy. I'm sure you guys have all studied it. I really think about what we've done so far, which is well over $2 trillion, as stabilization, not stimulus. I was a Boy Scout. I think of stimulus as trying to light a fire. I think of where we are right now. You could give me as much money as you want, and I'm happy to take it, but I'm not going to spend any more of it. You're not going to have a stimulus unless the kindling is dry. When kindling's wet, you're just going to get smoke. And so what these fiscal initiatives are trying to do is to bridge people who are temporarily out of position for reasons that are not their fault into a recovery. So you see an expansion in unemployment insurance. You see payments to low to moderate income individuals to try to bridge them. You see a small business loan program. You see funding to endangered industries like airlines. You see a Main Street lending program, which I'll talk about in a bit. They're all good concepts. I think the challenge in all these is that the government is not built to deliver money to people really quickly and efficiently. It's just not built that way. To give you an example, this notion of sending $1,200 checks to every working American. Well, the IRS has about half of our bank routing numbers from tax returns. Numbers that it has, by and large, are the wealthier half of the tax filing public, not the less wealthy half of the tax filing public. And so for them to send a direct deposit to individuals' account, they can do that. It'll take till April 15th, so 2.5 weeks from the legislation. There's no giant government printing machine that has the of each and every American who doesn't file taxes electronically. So they're engaged in a desperate effort to try to identify the other half of Americans, to try to figure out where their addresses are. By the way, even if they filed taxes last year, they've probably, a certain percentage of them have moved and moved frequently. Fraud is an issue, and you don't want a lot of articles say we've just sent checks to people who've defrauded the government. So there's a lot of challenges even in that program. You may have seen last week some press about the small business program called the PPP. Basically, a guaranteed bridge loan for small businesses. If you keep your employees for 2 months, we'll pay you some money, a loan which will be forgivable. Well, they, I think, metered out about 3,000 payments on Friday. I think by Monday, 100,000 applications. So again, for the SBA, Small Business Administration, which is a notoriously slow-moving entity, to deliver money quickly to small businesses that need it without fraud, with the support of banks, it's just a massively difficult problem. And so you'll see, for example, Mitch McConnell today said he wants to expand the small business program because they're going to run out of money tomorrow anyway. So these things are just very difficult to do, and legislators trying to do things inevitably won't get it quite right. So the second chair is fiscal. The third chair is monetary policy. That's what we do. And I'd say we've done 3 things. By the way, we're enabled because we're an independent agency. We don't have to go to Congress to do the stuff we're authorized to do. We can just do it. And so we moved weeks faster than anybody else did. We took rates to 0. That probably didn't create a lot of near-term stimulus, but it does create a positive environment for people who do need to take out loans in this time of trouble. We've sent messages to banks as the people who regulate the banks that micromanage you on the topic of giving forbearance to your good customers, things like mortgages or other loans. We've loosened a couple of their capital ratios so they could feel free to make the loans they thought were appropriate. We're working with them to take some of these small business guaranteed loans off their balance sheet. They have capacity to take more. And so we're doing our best to help the banks, help the country navigate this situation. The third thing we've done is try to make markets function. What you saw in the stock market panic of late February and early March was a freeze up in a lot of the core markets that individuals and businesses count on for funding: treasury markets, mortgage markets, commercial loan markets. And so we've been investing heavily directly where we're authorized to do it, which is the treasury and mortgage-backed markets. And we've set up facilities with treasury in the places where we're not authorized to do it, so that we can try to create some stability to money markets and to commercial loans and the like. Over the next couple of weeks, you'll see that the legislation authorizes us to set up a couple more significant and substantial facilities, one around corporate bonds for the $2 billion and up, and one for loans for the people above the small business and below $2 billion, called the Main Street Lending Facility. Very complicated to set up, but we're in the process of doing that. So those are the 3 lanes: health policy, fiscal policy, monetary policy. Maybe I'll just talk for a second about where do we go from here, and then I can turn it to wherever y'all want to go. The core challenges here is to get to the other side with a healthy economy and a healthy population. That requires the shortest possible duration of being shut down that's consistent with good health. And I want to emphasize that's not a 0 infection rate. Flattening the curve does not take infections to 0. Flattening the curve actually pushes the infections out to create capacity for hospitals. In that context, there are 3 things that I'm paying attention to. First is we absolutely need continued of our essential industries. We need food to be grown and manufactured. We need packages delivered. We need fire and safety. We need cleaning supplies. We need cash processed and hospitals functioning and supply chains operating and inspectors inspecting and electricity on and broadband available. And every one of those industries has a bunch of workers who today are taking a risk to operate on behalf of our economy. And it's really important that they stay healthy. It's really important that they stay motivated. But that's a critical part. And if that starts to break down, you've got a whole nother set of problems. The second thing you need is business and consumer confidence to return. This has been a real shock. we can get to the other side, but we need businesses to invest. We need consumers to spend. And as I said, you know, this will not be, unless we have a vaccine or a treatment, this will not be in a zero infection economy. This will be in a multi-infection economy. And so we're going to need a positive jolt here, or I fear that the slope is going to be very slow. And to create that jolt, I really think it's worth looking hard at a health protocol. In China, for example, businesses are back to work. People aren't getting sick. Consumers are slowly coming back. You know, our cash operation, we take people's temperature when they walk in, we give them gloves, masks, we enforce social distancing, and, you know, fingers crossed, we haven't had issues. So it's not like you're walking into a firefight. It's actually possible to operate businesses today and be safe and healthy. The real issue is, how do you convince consumers that it's okay to shop, that it's okay to go to a restaurant, that it's okay to schedule a vacation, stay in a hotel, take a trip, right? And I think that's a whole nother level of difficulty. After 9/11, we didn't really have the TSA as you know it today before 9/11. In the 3 months after 9/11, we invested a ton in security screening, security processes. It was a mess, if I'm being frank. But at the end of it, you kind of knew as a traveler that you were safe traveling. And I think we need a set of protocols that will convince people going to work and people going to shop that they're safe working and shopping. You know, what am I talking about? If you've been to a grocery store lately, you'll see what I mean. At the door with someone in a mask with wipes. And the first thing they do is they Clorox down your shopping cart and give it to you. And so the first thought you have is they take this seriously. The grocery store is not that crowded. So you're not worried that you're bumping into people and getting sick here, there, and the other. Maybe you wear your gloves to the grocery store and you put stuff in your cart. And then at checkout, you'll see there are sneeze guards. You'll also see there's tape on the floor enforcing social distancing. The figured out a protocol that people have gotten increasingly comfortable with that convinces them that you can shop for groceries and not put your life on the line. Well, I think restaurants are going to have to think about that too. Are they going to switch the mix between indoor and outdoor dining? Are there going to be fewer tables in a restaurant? Is the service going to be more self-service and less, you know, waiter returned? How about a shopping store? Are you going to see larger footprints, retail footprints? Are you going to see more online shopping? Probably. Is checkout going to be more automated? Are they going to enforce the number of people in a store? Or are you going to be met with people in masks and gloves? How about air travel? Is someone going to sit in the middle seat next to you sneezing? Or are they going to put a sneeze guard up between you and the person next to you? Well, hotels take your temperature before you walk in. I don't know if these are the right answers or the wrong answers, but I'm just saying the kind of jolt we need is either a vaccine or a treatment, or a set of protocols and procedures that you can convince yourself and your loved ones that it's okay to get out there and spend again. So maybe with that, I'll pause. Jamie, I don't know if there are things I haven't covered or questions that you'd want to attack.
Absolutely, and thank you so much for that overview. We have 8 questions from the students, so I'm thrilled for them to have the opportunity to ask them. I actually want to start, I want to introduce you to the president of our investment club. His name is Jesse Keatle, and he's going to take the first question.
Hey, thanks, Jamie, and thank you, Tom, for joining us today. I guess getting back to Fed policy, just generally speaking, what do you see as the greatest risk of the growing balance sheet at our Fed?
First of all, I want to wearing a tie. I was hoping everyone would show up and look that good for today's session. The balance sheet was very controversial 10 years ago. We had a relatively small balance sheet. In an effort to try to stimulate interest rates, we added a bunch to the balance sheet. People were worried that inflation would take off. That hasn't happened. People were worried that we would be co-opted into basically financing the government, buying a lot of securities and things we didn't. That has not happened. People were worried that we would never take it down again. And in fact, we took it down last September. We actually took it down probably to the minimum level we could take it. And so sort of having proven that those 3 fears, at least in the last 10 years, didn't come to realization, I think we could operate this time with a lot more confidence on the balance sheet, that we could move faster and we could move harder and we could move with a lot less political risk than we had the last 10 years. And I think that's going to be the case. Dodd-Frank actually reinforced that we're only allowed to buy certain things on our balance sheet, which are basically government guaranteed securities, treasuries, and mortgage backs. So I think the issue of us somehow subsidizing other parts of the economy has gone away now. Congress can always change that, but they haven't so far. We have certainly have not seen inflation at any scale, and we've proven we can take it down. So I don't think there are massive issues. I want to also say what we're doing, which is really important, is helping markets to function. You basically had a bunch of hedge funds which panicked in the context of the stock market rout in late February, and they had to sell out of some heavily leveraged positions. And the selling pressure was so great that there were no buyers on the other end. And that may have been reinforced by the fact that a lot of Wall Street is working at split operations. So people working from home maybe can't work the trading desk quite as aggressively or even as seamlessly. And so you had very wide spreads in markets that ought to be very liquid. And so by buying, we weren't trying to move interest rates. They were already low. We're just trying to make markets work. And so I think, if you will, the purpose of this was also a little easier to take politically. So we'll see. But so far, I think not a big issue.
Thanks for that question, Jesse. All right, Ben Miller, you had 3 great questions. So if you want to choose one of those, and you have the floor.
Okay, can you hear me?
Yeah.
Yes.
Okay, great. Tom, sorry for disappointing by not wearing a tie. But,
No, I think Jesse really looks a lot better than you do.
I appreciate that. Um, yeah, like Jamie said, I have 3 questions. I guess I'll start with this one. Going through this whole process, what is the dialect or the relationship like between Fed and the Treasury and Congress? Obviously, the Fed is supposed to be independent. Regarding the creation and passing of the COVID-19 stimulus packages, are there many disagreements between which monetary policies to enact? Did Congress or Treasury have differing ideas than you guys? I guess kind of what was that?
Yeah, and I'm pretty sure I got the question, which is how's the relationship between Fed and Treasury? So I'll give Jay Powell a lot of credit here. He's taken a lot of incoming over the last couple of years, and the way he's handled it is to just keep a stiff upper lip. And I think he's earned a lot of credibility with the American public, but also with both houses of Congress having done it. He's also kept very close ties to Treasury. He was in the Treasury Department in the Bush administration, first Bush, and so he knows how that group functions. And our mantra is we do what we do and we leave to others to do what they do. We're not trying to do what the legislative bodies or the executive branch need to do. We are doing, as you could tell from what I said, the stuff that we're chartered to do. Importantly, Dodd-Frank made clear that these special purpose vehicles, they're called 13(3) facilities, they have to be approved by Treasury. And so we have worked from the start to work alongside Treasury. And as Treasury was working with Congress on getting these vehicles funded, we worked alongside Treasury on that. I think the working relationship's actually quite productive, in part because we're not trying to do their job. We're just trying to do what they've got on the other side of the table, political, and just trying to make these markets function in the best way we know how, and has the tools to do that. And we have a lot of tools Treasury doesn't have. So they like our attitude and our tools. We respect their role in the system. Every facility we do has to be approved by them explicitly. So they have the power to approve. By the way, we also have the power to not do it. So it's a pretty fair negotiation as we, I think, genuinely and legitimately try to design them to get it right. I'll give you an example. One of the things we're working on right now is called a Main Street lending facility. It's been it's been named by Congress, but not really defined by Congress. And so you have these issues. All right, let's say we want to lend money to appropriate billion-dollar companies that are in need. Well, how do you identify who's in need versus who's not in need? Everybody would love to have the money. So that, if you will, borrower selection's a challenge. How much credit risk do we want to take? Right? We're not allowed to have any losses. Treasury has to take all the losses. So how much credit risk does Treasury want to take? Do you take only really good borrowers who are illiquid, or do you take some people who are close to the edge and run the risk that, 2 years from now in some political hearing, someone will say, why'd you lend the money to that guy? On the other hand, aren't those the people who are hurting the most? How do you underwrite these loans? We don't have a whole underwriting staff that makes loans. So should we depend on banks? Okay, if we depend on banks, how do you divide the value between the bank and the treasury? The loss share, benefit sharing. How do you do it so the banks are appropriately incented but not too incented? These are the kind of issues that are why these things just don't get launched immediately. It takes weeks to sort of lay them out. And I think you can trust there's a good adult conversation going on between well-minded people on both the Treasury and Fed sides to try to land the plane on this.
Ben, did you want to ask your follow-up questions?
Sure, yeah, I'd be glad to. All right, thank you for that answer. Going off of that question, slightly, can you walk us through the process for the emergency rate cut? Or can you hear me?
I can't really hear you. I heard rate cut.
Okay. Can you walk us through the decision-making process for the emergency rate cut on March 3rd, and kind of how long did it take, who was involved, what pros and cons were being?
Yeah, so this is one of those parts where I can't tell you what I can't tell you, but I will tell you. Let me just talk process for a little bit. Each and every one of the 12 reserve banks and the 5 governors has their staff who is constantly watching the economy and thinking about what appropriate policy looks like. The virus showed up in Washington, showed up in California, and you started to see community spread. And so a lot of these forecasts started to raise the question of whether we were going to see something pretty ugly coming in the near future. At the same time, the week before, I think the markets started to crater. And so you saw a real loss of confidence in the economy. What Jay, who's the chairman, I always say there's only one guy with a pen, and that's Jay. So he called each and every one of us to take our temperature and to basically pose the question, do you think this thing's serious enough that we ought to be doing something? He then on Friday said, we're watching closely. And then as things moved on, I think it was Monday night, we had a call. And he basically sent a note around saying, look, I've talked to all of you, and I think there's a lot of support to do something. So then we showed up in the room. And the minutes for this, I think, are out now, but if not, they're coming out the next day or so. So I won't get into the conversation, but which is very accurately portrayed in the minutes. But there's a real conversation about those who would say whatever version of move fast and move hard and get ahead of this thing, versus those who say, are you really sure it's that big a deal? Let's have that debate. Versus those who would say, I think it's a big deal, but I'd rather save my ammunition for later. That's been a multi-year debate on the committee in various forms and functions, and that's always going to be it. Separately, we had a scheduled meeting, I think the 16th and 17th of March. We had another emergency meeting the Sunday before that. And it was very similar. Everyone was preparing for the meeting. We had to go around. They made the call of saying, you know what, it's pretty clear where we're going to go on Wednesday. I think it would be very important for us to go earlier. By the way, we were all remote at that point, social distancing. So it wasn't like he had to get everyone together. We just we spent all day Sunday on a video doing that debate, and then that was announced, I think, Monday morning.
Thanks for those questions, Ben.
Thank you.
All right, Michael Good.
Hey, Tom. Thanks for making the time for us, and also for accepting my invite to connect on LinkedIn earlier this morning. I'm
just glad you didn't post anything. I was very nervous about what you were going to do.
My question kind of piggybacks off your last key point on, where do we go from here? So you mentioned if we need to come up with a treatment or a set of protocols to boost consumer confidence. If that doesn't happen in the near future or distant future, I mean, what exercises in monetary policy, fiscal policy, or other vehicles can aid our country in avoiding a depression?
Yeah. Well, that's why I start with health policy. I mean, I think the most important policy right now isn't fiscal policy and isn't monetary policy, it's health policy. And there are lots of different ways to land the plane on the health policy. The best would be a vaccine. Then we'd all have the vaccine. We could all just go live life the way it used to be. Another version of it is a treatment. And if you had a treatment, then maybe my mother, who's 85, still wouldn't go out, but the rest of us would go out with some confidence that, if we had a problem, we'd get treated. Another great policy is testing. And this is actually what they've done in Hong Kong and Singapore, and it seems to South Korea, it seems to work, which is if we had availability testing at scale. I've thought about, my daughter's a sophomore in college. I've thought about what it would take to get school back functioning next year. And one way to get it back functioning would be if you actually had a test and everyone who came back from wherever they came got tested as they walked in the door, just like you take an entrance exam or whatever else. That wouldn't mean that everybody was safe, but you got a population that by and large is going to recover. College is a hothouse anyway. People are always getting sick. So it's just one more illness that people will recover from. But you've taken some actions to assure people that they can be safe in whatever environment they're in. That's another version of it. But I think absent tests, absent treatment, absent a vaccine, you are asking people to leave home and take whatever version of their health in their own hands. And I just think that's very scary for a wide range of people. And because of that, I think people are just going to be judicious. That doesn't mean if you release constraints that people won't do anything. You might still convince yourself to go rent a beach house for a week and go drive to the beach house and stay in the beach house and do a beach vacation. Okay. I can say maybe you'll even go to somebody's Airbnb with enough wipes, right? But are you going to get on a plane? Are you going to go to South by Southwest, Burning Man, or whatever? I mean, I don't know. I think it's going to be, and I'm a huge sports fan, but am I going to go to an NBA game? I don't know. There's about 15,000 people there. I don't know any of them. That seems a little scary. And I think that's the kind of thing we're going to have to work our way around. And I like to put it that way. What's going to convince you it's okay to go to an NBA game?
Right. Awesome. I appreciate your insight on that.
No. I'm hoping that something will land here soon.
Ashley Bonsamino, you have the floor.
I really appreciate your time. I've got a long and a short question. I'm going to start with the short one because I'm pretty sure it'll be long for you. I'm hoping you can lend some insight. So to that point about getting markets moving, you always hear stories and talk about negative interest rates. Is that on the table? Is that a possibility? And what are the implications if we ever made that move?
Yeah, so one of the fun parts for me, just being a guy who's in business for 30 years and then working with a set of economists, is I do like to be able to call the question on when something makes sense or not. So, negative interest rates are I like to say they work beautifully in a model. It's just that life's not a model. So the theory of it is rather than have interest rates at 5 basis points where they are this morning, take them to negative 75, and wouldn't that create more stimulus? The issue with it, first of all, is it actually kills bank profitability. By the way, most banks aren't getting paid to hold deposits in Europe. They're actually still paying zero. And so they get squeezed on the loan side. And so it really hurts an important sector if you want the economy to come back. Second, I don't know a better way to say it, but the whole theory of interest rates is that you stimulate spending today that otherwise would have happened tomorrow. I lower rates, you buy a house, you buy a car, you make an investment. I think there's something psychological about negative interest rates. It's also true, by the way, at zero interest rates, where eventually you go, well, why hurry? Yeah, I can buy it now. I can buy it a year from now. It's still going to be zero. And I think the evidence of negative is once you go there, you don't really go back. And so Europe and Japan are both on it. I mean, they're surviving, but I don't really aspire to be either one of those places. And so I'm not in favor of it. If you look at the minutes in October of the FOMC, you'll see, which I know you were reading yesterday, you'll see that nobody's really in favor of it. So I'd much prefer us to get moving another direction.
Thank you. That's very helpful. You know, kind of on that same point, I had a question about major consumer purchases. We've been talking a lot about keeping money moving. I've been paying off my undergraduate student loans for a lot of years now, and I finally decided that I would go house shopping in January. That does not seem to be the most prudent action at this point. Do you have any, is that a consideration? Those major purchases seem to be something that would keep us moving towards that, would keep money moving and keep that consumer, would require a high level of consumer confidence. Yeah.
Yeah. I mean, I think when we were a year ago, the question of the day was, are we about to go into a recession? And so I did a lot of work on what are the indicators that tell us if you're about to go into recession. And for sure, the leading indicators are consumer spending on big items. So houses, cars, washing machines, those are the things that they're big purchases. You know, you can defer them if you need to. And so if consumers have confidence, they'll spend now. And if they don't, they'll spend later. That's also why monetary policy works. Because if you lower interest rates, you do make it a little easier to buy a house, buy a car. And if you raise interest rates, you do make it a little harder to do that. And so, if you will, it's a direct vehicle to go straight to the number one issue in either stimulating or contracting the economy. Now, we have taken rates down low, and if you look at mortgage rates, they're at historic lows. And so I don't know how you were thinking of financing your house, but if you were thinking of financing it through a mortgage, right now there's as much financial incentive as you could imagine to do it. On the other hand, being rational, you're going, I don't know if this point in the economy is now the time to do it. And that's always the yin and the yang of these things. The economy starts to turn back up when enough people on the margin say, screw it, the prices are good, the interest is low, I'm going to do it, as opposed to, holy cow, I don't know where this is going, I'm going to pull back. And you're right at that. I mean, what we see right now across the economy, autos were selling in February at an annual rate of 17 million a year. In March, 11 million. BMW is closed down in Greer because nobody's buying any cars. And so they've got all this inventory and they're saying, I got to wait till somebody starts buying again. That's the kind of thing that happens. At some point here, people will get confidence, they will spend, the autos will start flying off of the dealers' warehouse floors, BMW will start up again and the economy will get moving. That's what we're hoping for.
Great. Thank you so much.
Thanks, Ashley.
Caleb Norman.
Hey, Tom. I just want to thank you again for meeting with us today. This is actually a really cool opportunity to learn about.
Glad to be here.
I just have one question for you, and then you can move on after this. And it kind of touches back to what you said earlier with Jesse. It's what is the possibility of hyperinflation to increase money supply? You said earlier that that's not really happening. So what measures are in place to keep it, and why isn't it happening?
I think it's you're on one of the great mysteries of current economic policy. Because when I was in school, we learned that the money supply drove inflation. Now, the money supply is complicated. You can't measure it, and people aren't just using cash anymore. But there's still a theory that if you keep rates low for long enough, if you print enough money, that you'll have inflation at some point. And while I think that's true, you really can't find it in the data. And I guess what would I say is going on? One thing that I think is clearly going on is that as compared to the world that people lived in 15 years ago, there is a whole lot more price transparency than there ever was before. And so if I think about how I used to buy books then, go to a bookstore, look at a book, buy it or don't buy it. Today, go to a bookstore, like a book, don't buy it, check the price on Amazon, decide to buy it online, to buy it in a book. That's going to hold prices down. That's just going from a less competitive market to a more competitive market. On the other side, you see retailers aggregating at scale. Home Depot and Lowe's, Walmart, you could even put Amazon in there, Target, Best Buy, and these guys have incredible buying power. And so the second thing I think that's going on is you've gone from a more competitive marketplace where what you were going to get was sold to you locally and versus a more market power where there are intermediaries now negotiating on your behalf with real market power. And those of you who've been in businesses like the ones I mentioned, you know the kind of purchasing power they have and how they demonstrate it. I talk to really big manufacturers and I say, oh, you know, you had this tariff on your product, are you going to go to Walmart and increase your price? And they go, oh no, I can't do that. Why can't you do that? Walmart won't take it. Period, the end. And Dollar Tree and Family Dollar would be in the same place. So all these big retailers, and I think, by the way, they're only going to get bigger in the aftermath of this current thing because the small retailers are going to get smaller. So that's a second thing. A third thing I would point to is something around expectations. I grew up in a world where we expected inflation to be 5 to 10% a year. And so, you know, when you got to the grocery store and your Hershey bar had been cut in half for the same price, you said, okay, that's just inflation. I think consumers everywhere are in a world where they're just not looking for inflation at all. We've set a target of 2. We've delivered about 1.6 for the last 20 years. Maybe you think it's going to be 2 or 1.6, but nobody thinks inflation is going to be 5. And so consumer price elasticity is just higher than it used to be. And I think that seems to be enduring. So you have to test yourself with what would it take to break the chain on that. It would have to be 2 things. It would have to be, first of all, a set of jolts that affected the pricing people so that they felt like they were going to have to pass those costs on. They were going to have to increase prices. You know, what would it take for Dollar Tree to become $2 Tree? I made that up, but you know what I'm saying. And then the other part of the puzzle would have to be that would have to be sustained. You'd have to change expectations. So it was noteworthy during the tariff thing about a year ago that a certain set of items like steel did increase in price. But it's now a year later, people aren't looking for another increase. They're saying, okay, I want that back. And so I just think we've embedded a pretty strong, I'll call it zero inflation, but some would call it deflationary mindset in the minds of consumers and businesses. And that's going to be hard to break. Thank you.
Chris Sugar, I know you have a question that's non-COVID related. You have the floor, my friend.
Appreciate it. Good afternoon. Try to break the mold a little bit here. But what is your take and thoughts on non-banks, shadow banks, fintechs that have entered into the financial space in the last few years, and then maybe how will they be impacted through this? Kind of put your regulator hat on for just a second on where you see them as consumers and then as a regulator.
Yeah, so innovation's good, and so we ought to applaud all innovation. You know, I certainly enjoy my E-Trade account, if you want to think of them as a innovator. I certainly like Venmo. So it helps all of us to have innovation in financial services. I think the thing you have to worry about, and I do worry about it, is level playing field. You know, if we are regulating money laundering, for example, in the banks, then why aren't we regulating money laundering in cryptocurrency, for example? I mean, we ought to be a level playing field. And the other thing I worry about are risks we don't know about. So one thing that's in the paper right now are mortgage servicers. And you guys, with the exception, I think, of Ashley, are not familiar with the mortgage value chain yet, but or as deeply as I am. But basically, you go to a bank, they originate a mortgage, they then sell the mortgage to somebody. And often that's Fannie Mae or Freddie Mae. And then there's a set of non-banks that are out there servicing the mortgage. Servicing is collecting the monthly mortgage payments, following up if you need to be foreclosed on, all those kind of things. Well, there's a huge kerfuffle right now because these mortgage forbearance that people have laid out, in other words, pay your mortgage 3 months at the end, have exposed the fact that these non-bank servicers have to pay these guaranteed payments to Fannie, Freddie, and Ginnie Mae. And that means that they're getting nothing in and they have to pay a lot of money out. Or put differently, they were massively leveraged in ways that we didn't know about. Okay, that seems like a problem, right? And so it seems to me that if you're going to have these folks out there, you ought to have the same kind of stress testing of their business models that we put the banks through. Or you're going to have, you have people telling Congress, we're going to shut down the entire mortgage industry because this is going to happen. It's craziness. But it's craziness because it's outside of the regulatory perimeter in a world that we've sort of said it's good to be regulated. I'm not a fervent regulator by any particular means, but I do think if you decide that some stuff needs to get regulated, then you ought to regulate all the stuff. Another good example would be cyber. We put the banks through massive resiliency tests on their cyber, but what about the people who supply the banks? Easy one to think about would be Google Cloud. We don't regulate Google Cloud. Well, a lot of people are using the Google Cloud, and do they have the same kind of protections and resiliency that the banks do? Pretty important. That's just another way to think about it. A third way that's in the current environment are commercial loan funds. Corporate debt as a percentage is at an all-time high. Most of that's actually not at the banks. It's in CLO, collateralized loan origination funds, which are in hedge funds and private equity firms and non-banks. Well, we don't know where it sits. We don't know whether it's levered or not, and we don't know if spreads gap on corporate loans, especially high yield corporate loans. Who's going to be left holding the bag? And all those things are kind of crazy for a regulatory regime. Last point. Well, Tom, why don't you fix it? We don't actually own that, right? We're given by Congress the right to oversee banks. We're actually not given the right to oversee non-banks. So you'd have to have a regulatory reform law that sort of extended the perimeter. And I was going to give a speech actually in Charlotte a week and a half ago saying exactly this, which is why I'm live on all my examples. It's good and rescheduled, so you'll hear more about it. But I think we do need a little more authority, again, just to create a level playing field and to get comfort that these things we all care about are actually handled.
Appreciate that. I have a second question is not to make it political and don't want to sway my thoughts or your thoughts on it, but about 20% of the workers out there are going to be basically supported by government funding. So is this any type of experiment for universal basic income? Is this some way to see how this works and the deficit load that the country handles and how they pay people not making, we'll call minimum wage or less?
Yeah, Guy, if I were going to do an experiment, I'd probably do a more controlled experiment just as one person. But so let's just talk about this, because I said earlier, I think that 30 million people are employed in retail or restaurants or hotels or airlines. And it's a sad story. I mean, that's really where the growth of the US economy has been, is in these lower end service workers. So we're sending these people home. We're giving them some amount of bridge support. As you know, a $1,200 check that covers 2 months is not enough to survive on. It's not basic income at all. But where do we go from here? And I think we have a real issue, because if I were running a restaurant or a retailer right now, I would be thinking about, I don't mean to say this the wrong way, but how would I be de-health risking my entity? And part of how I would de-health risk it is I would reduce the human to human contact in the business I've got. I would think hard about investing in self-checkout at every checkout line, because that just, you don't need a sneeze guard if you've got a self-checkout. I'd be thinking hard about a little more space to give people distance and a little bit fewer employees. I'd be thinking in a restaurant about, why do I have this whole thing where somebody comes in and brings a bread tray and then they come bread plate and they bring, maybe I ought to be taking a lot of the back and forth of the waiter out of the equation. Maybe people go pick it up in the kitchen and bring it back to, I don't know. But I'd be thinking hard about de-peopling those jobs. And if that's what you're doing, that's a lot of these people out of work. And Several in both parties have talked about infrastructure programs, which I certainly would support as a concept, but I don't think most of these workers are your prime candidates for infrastructure programs. They're not trained welders or carpenters or whatever. And so what are they going to do? It's a pretty interesting and pretty important question. I'm not sure we sort of thought our way all the way through it. I am not one of those people who believes that by giving them a $1,200 check or enhanced unemployment insurance, that they're never going to go back to work again. I just don't think that's how the real world works. I think all these things expire, they're going to expire. And when they do, people need money. And more importantly, I think people value work, try to work. But I do worry about how the job mix is going to change and whether enough jobs are going to be available of the right sort on the other side. I'm on my soapbox on this. Let me just talk about one more. Home health workers, right? That's a massively growing part of the economy, in part because my generation's aging and we're going to do so grumpily. But where are all those people going to come from? And that's actually a whole nother unique skill. It's not at all obvious to me that a lot of the people who are displaced, whether they be blue collar or retail workers, are your perfect home health workers. So we're going to need to come up with those. And we don't pay much for home health today, but I'll bet you in a virus environment where old people are more at risk, you're going to need to pay a lot more to get people to be a home health care worker. So again, I think there's a lot of interesting complexity about where the job market goes. And I do worry if we don't get a treatment or vaccine that it's going to hit us quickly.
Appreciate it.
Thank you.
Thank you for that. Joe Landsberg, you have the floor.
Hello. You've already touched on some of these questions, so I'm going to try to make it a little bit more pointed. Historically, how effective has consumer stimulus programs been? Where has it failed? Like, have you seen where it's really failed miserably?
Yeah. So I do think consumer stimulus does have its effect. There's a lot of research done on it. You can track it down in the models. I'd say giving money to the poorest part of the population leads to more spending than giving money to the wealthiest part of the population. If you give money to the wealthiest part of the population, they on a marginal basis have more marginal propensity to save, and the poorer part, they have more marginal propensity to spend. And I think it is a fact that in the poorest half of the population, pretty much everything that comes in gets spent. I think there are also business stimulus programs that you could look at and look at the history. And here I think it's a little bit more mixed. I think whether it be tax relief or other sets of investment programs, I think businesses have an investment horizon, they have an investment picture. They generally aren't going to rethink investments without something that makes those investments look more attractive. So I don't think a give, if you know what I mean, I don't think giving of money into businesses, like take the tax cut, changes anything without an investment incentive, right? And so I think you have to go more directly on the business side to where you want to go. What I did say up front, and I do think it's true now, is that we're not engaged in a consumer stimulus program at all. We're engaged in an income replacement program. We're engaged in a fiscal stabilization program. You could give me or a laid off retail worker as much money as you want, and there's only so many things they're going to spend money on. I mean, there's almost nothing that's going to convince you to take a vacation right now. It's just another way to think about it, as that part of your earnings. It doesn't mean you won't spend it on food. It doesn't mean you won't spend it on shelter. But if you will, that extra set of things, the car dealers are closed. So how are you going to buy a car? I know you're going to bring up Carvana, but even Carvana has human contact in the last mile. So but it doesn't mean it's not out there. It doesn't mean it won't come back. I'll just say one other thing. You didn't ask the question, but I'll say it. Fed stimulus. There's a real debate in and around the Fed about how much lowering or raising interest rates is truly stimulating the economy. It also relates to the earlier question about inflation. And I think that's a much more, I think that's very different than, if you will, classic putting money in consumers' pockets. And I think there are real questions about that. I'm convinced that the things I talked about earlier, mortgages, auto, heavy durable sales, I'm convinced they do move. You can see it as rates move up and down, you can see the volume. I'm less convinced that having rates at 0 today versus having rates at 1.5 today meaningfully changes the path of the economy beyond those particular items. Just I think there's so much else out there in uncertainty that means almost any change in discount rate isn't going to matter because the uncertainty trumps it. I think you're on mute.
Sorry about that. We better? Okay.
Yeah.
Got one more. With long run and low interest rates, how has this negatively impacted what we classified as the savers? And what's the future for, like the boomers that are going into retirement and having to choose like more risky investment plans, as they're in more fixed income?
Yeah, it's got a big issue for savers, including me. So I take this very personally. But I think I want to say, rates aren't low just because somebody at the Fed decided they should be low. They're in part low because demographics are driving them low. And what I mean by that is people have different consumption and spending patterns at different parts of their life. Across the world, the population has gotten significantly older, and in particular, the population that's 60 and up, which is what I classify as old given that I'm 58. They are those who are saving by nature, right? And those savers who are, they got their money in the bank, and they're very conservative with it. Bigger share of the population. And they're looking for safe instruments. So there's a shortage of safe instruments, which is what's driving rates down. So we tried to take rates up about 2 years ago. We got them up to about 2.5. When we got to 2.5, things started to come off of it. It's all a judgment call how high you can take them. But it sure didn't look like that was an economy that was ready to take 4. And so it's not just that we're taking them low. Anyone would have them low in this environment, but it's not just that we're taking them low. It's also that the dynamics are such that it's driving them low. And that is a real issue, I think, for savers. Final thing I'll say is this whole reach for yield thing is a real issue. If you'd gone back just 3 months, the stock market valuations were elevated beyond what most people thought was rational. High yields were much lower than people thought were rational. Almost every investment instrument you could put it in was at valuations that people think was rational. And I think that's why you saw the markets collapse so suddenly in February, is that everybody who's invested in all those things knew that it wasn't rational. And so at the first sign of any fear, they went boom, right into cash, which is why markets kind of stopped functioning. And so I do think low rates for a long time motivate people to put money in investments that just aren't that rational. Thank you.
Thanks, Joe. Ben Miller, I see you have another question for us.
Oh yeah, I did. Kind of going off a different path here. Japan has been in the liquidity trap for many years. Kind of wondering, with interest rates so low, have they looked into that? Is there any measures to counteract this should it occur, or what's their stance?
So you're hard to hear, but I think your question is Japan rates have been low. Why are rates so low? And there's anything we can learn from Japan? Was that the question?
Kind of. So they've been in a liquidity trap, correct? So I'm kind of wondering, has the U.S. Fed studied that? Do they have anything in place to counteract that should it happen here, or if they even think it's going to happen here?
Yeah, I mean, I said earlier, the last thing I want to be is Japan. But Japan has a massively aging population, much more than ours. Japan has a government organized set of business infrastructure that when I was in business school, we learned was going to be the secret to the world. And I think what we learned in the 90s is it's kind of a disaster from an adjustment standpoint. My best example is we went to Japan about 3 years ago, stayed in a Japanese airport hotel before we flew out to the island that we were taking a trip on. I went to the airport at 6 a.m. for my flight, decided I had some time, I'd get some yen. went to an ATM, put my card in there, and it said, "I'm sorry, the ATMs are only open 9 to 5." Because in Japan, for some reason, the government has decided to protect the banks that they're only going to keep the ATMs open 9 to 5. That's the kind of inefficiency that exists in lots of different places in Japan. So, you know, the analysis we've done in Japan is they had their problems. The business environment didn't have enough vibrancy to get them out of it. And the government has multiple times, including now, raised rates or raised taxes at times just when the economy seemed to be recovering. They have a consumption tax that went into effect in the fall. Well, I mean, consumption tax, to someone asked it earlier, is like the classic way to lessen consumer spending, right? But they went and did it because they've got budget issues. So I think it's been mismanaged. I think it's been the business environment's not that good. They've had negative rates for a long time. They've got more demographic problems than we do. But there's no guarantees. And you know, that's why I think our business vibrancy and our growth as economy is really critical to having the vibrancy to bounce off the floor, which we did nicely, you know, circa 10, 11, 12 and onward. But we're going to need to do again, obviously.
Thanks, Ben. Andrew Chowdhury, you had a couple of questions for us.
Yes, thank you so much. Thank you for coming out and talking with us. One of my questions, I originally wrote it, but I kind of want to ask it the opposite way. So originally, I wanted to ask you about a decision that you went along with the majority, but I think I'd rather ask, has there been a time where the majority of the Fed agreed upon something that you disagreed with? And if so, do you believe that was due to your business background?
No, I just think it was due to the fact that they weren't as smart as I was. No, I'm teasing. I vote every third year. So in the years that I voted, the decisions of the Fed actually were completely aligned with what I wanted to do. Last year, though, we took rates down 3 times. And I'll get the dates right. I think it was June, July, and September. It might have been, I think it was actually July, September, and October. And at least 2 of those times, I did not think we should take rates down. You know, again, it's a delicate trade-off. It's a trade-off between the value of having ammunition for the future and the desire to get ahead of what the majority of members on the committee thought was enough uncertainty in the trade environment that, you know, the economy was at risk of moving the wrong way. And, you know, the great thing about the economy is it's hard to, we'll never know who was right. Because we were all debating about, in an unmanaged outcome, what would happen this June. You know, would we need the stimulus or not? And obviously, you know, we didn't have viruses in our thinking, and so we didn't know it. Why was I unable to make a successful case with my peers in the room? It's hard to know, honestly. I, of course, you know, made my case as strongly as I could, and I'm highly convinced that it was articulate and compelling. I'm joking a little bit. I'm actually not joking. I was convinced I was compelling, but I think people come from different places, and so I think it is quite possible that there were some people who were just much more focused on inflation than I was, and inflation's down, and let's give it a shot. And I was in the world of, come on, it's 1.7, it's 2.0, it's all rounding, what's the big deal? So maybe there's something to how you think about inflation, you know, how seriously one would take it from a different profile, maybe. Maybe there's more belief in some cases on the power of interest rates in an uncertain environment versus, you know, I'd probably like to see the uncertainty come to fruition. They're judgment calls. It's a rational debate. There are thoughtful people on all sides. I don't feel like I'm in a political thing. I feel like I'm in a room of trusted and valued colleagues who are making different variations of the case. And in the end, you know, people vote. And sometimes I win and sometimes I lose.
Thank you for that. And I can ask you one other question.
Sure.
So what large effect would you say that aiding small businesses has on the overall economy?
Well, so I mean, the basic answer, which is true, is small businesses are a huge part of the economy. It's where a lot of the innovation comes from. That's where a lot of jobs come from. It's where the future big businesses come from. So aiding them helps the economy. I think a more complicated answer is you actually have more churn in small businesses than you do in larger businesses. And so there's a lot of startups, but there's also a lot of wind. Um, I personally don't think of this as a small business, big business thing. I come back to where I started, which is in the pursuit of your and my health and in the pursuit of ensuring enough capacity in the healthcare system. We decided just kind of, arbitrarily to tell a bunch of businesses you need to shut down. And that's different than they had done something of their own fault. I wouldn't have a problem with a restaurant that had lousy service going out of business or whatever, but it does feel a little bit unfair if you're in that. And even if you're not in those businesses, it feels a little unfair to me too. So I don't have a problem with the notion of us as a society making a healthcare cost, and if you will, paying the full cost of that healthcare choice into those people who are affected. I think, though, it's totally challenging to get it in the right hands, not the wrong hands. There is somewhere out there a restaurant that was going to go out of business tomorrow because the food was terrible, that's now got 2 more years of life. It's hard to get it right.
Thank you so much for answering my questions, and thank you so much for taking the time.
Yeah, glad to.
Thank you. All right, Tommy Mastercolas, you have some questions for Tom.
Hey, Tom.
Hi there.
Thank you so much for conducting this. So I have a question on unlimited QE. So what exactly is it? And also, how has unlimited QE affected or impacted other central banks throughout the world globally, such as the ECB, et cetera?
Yeah, so first of all, that's a lovely set of china right behind you. I don't think we're doing unlimited QE. So I'll just start with that. We are purchasing a lot of treasuries and mortgage backs. Start with the question of what are we trying to do? In the QE era, what we were trying to do was to manage down long interest rates. That's what we were trying to do. We had a perspective, I wasn't there at the time, but we had a perspective that the yield curve was pretty steep, with it, which means for those who aren't in the markets that rates on longer bonds were a lot higher than shorter bonds, that we were going to keep rates low for a longer time than the market gave us credit for. And so by buying longer term bonds, we would send a productive signal of where we thought rates were going to go. Today, that's not the issue at all. The yield curve is quite flat, and medium long-term rates are not high at all by any dimension. What we're actually trying to do is to intervene in markets that are not working until such time as they start to work, but not beyond such time as they start to work. I don't see this as unlimited QE. I see this as targeted asset purchases with the desire of bringing spreads down to normal levels. And once spreads sustain at normal levels, I hope we'll be out of it.
Excellent. Thank you. Another question too is, so the Panic of 1907, I just did a little research, and that's kind of what stimulated or sparked kind of Nelson Aldrich to go out and look at other places throughout the world and kind of devise of this Federal Reserve System or bring a case for it. In this time, we have another type of, one could argue, some kind of a panic. In this case, it's more biological. Do you feel like we're in a position to look at what others are doing, or can we actually still continue to kind of make that first step and have others follow us as a country?
Yeah. You may have read this book. There's a great book by Bob Bruner on the Panic of 1907. Maybe that was one of your textbooks. So this is a lot different than the Panic of 1907. For those of you who are not as close to it, basically you had a run on all the banks, and you had J.P. Morgan forced to get a few of his buddies together to finance the banks. And I think the government sort of said we shouldn't really have one guy and his buddies, people responsible for the bailout. And that's why the Federal Reserve was created, to support the banking system, which is really what we did in 08. I think 08 is very comparable to the Panic of 1907. This is a totally different situation, which is um, to me, a lot more like 9/11, which is that something has happened unforecasted from the outside that's put a lot of this economy and the businesses at risk. And again, we're in the third chair. I think first chair is health policy, second chair is fiscal policy. Health policy needs to get us under control in the same way that TSA assured us that traveling was safe. Fiscal policy needs to make whatever decision it wants to allow a bunch of businesses that were in existence before this health crisis to survive after the health crisis. And then we just need to make sure markets function. And that's what we're doing.
Great. Thank you.
Thank you.
Thank you. All right, let's go to Shivam.
About what was that?
Oh, go ahead. I didn't know if you were still with us. Go for it.
Yeah, no, I'm here. Good afternoon. I was Shivam Desai. I was interested in the stimulus package that just got passed, or I know we're talking stabilization now, with respect to the strings attached for large corporations. So I myself, right, I work at Boeing, so we have a lot of concerns, right, with the airline industry, and our CEO has kind of spoken out a little bit as well about some of those strings. So wanted to hear your thoughts on it, and if it's a good path forward.
I think the legislative process is a very messy process. I think it is really hard to get legislators to sign up to give money to businesses. And when you do, they will want some strings attached. And, some of the strings that are attached to some of these things, I'll talk about airlines for a second, include executive compensation, include share buybacks, include policies like sick leave and whatever. I'm not that in favor of trying to, rule companies from the legislative side, but I have to say, it doesn't really bother me to say, if you'd like government money, here's what a, balanced bipartisan legislatures decided, you would need to accept that money. And then I think the business has the right to accept or not accept it. And in 09, 08, I remember having a senior executive at one of the top 5 banks in the country sit down with me in a meeting, absolutely pissed off about some of the stuff that had been required of him. And I was like, I guess I understand that. On the other hand, you realize the banks did put the entire economy into this, right? He didn't like that much, but that's kind of how I felt about it. And I know the airline business very well. I ran the airline practice at McKinsey for many years. These guys did absolutely nothing to cause this problem. They were running good businesses with high leverage. On the other hand, in every disaster plan, every single company in this country knew that pandemic was a thing that was on the disaster plan. But the problem is no one could conceive that the pandemic response would look like the one we're doing today. And so as a result, people were more leveraged, they flew more, they did whatever. They financed it however they financed it, and we are where we are. So I think Congress has the right to put whatever constraints they want to on businesses. And even if I don't think they're the right constraints, like buybacks, I don't think that's a big issue, honestly, in this environment. A 12-month moratorium on buybacks, it's not going to happen in the airline business, but it's their right, I think. And I think the businesses like Boeing have the right, as your CEO apparently did, to say, that's all fine, but we don't want it.
Mm-hmm. And I guess the other part would be, protecting the entire supply chain. I know for us, it's like for every one Boeing job, there's 10 in the supply chain somewhere, right? Someone's welding a disc, someone's doing something. So those would, like Boeing usually proactively pays those suppliers, right? With our site shutting down, are there avenues to help protect the entire supply chain and get it? Because a lot of those are small businesses. So.
Yeah, the act, and again, I won't defend the act. Anything that's done legislatively is sausage making. You just have to wake up at the end and figure out how to deal with it as you will. It doesn't actually mention Boeing, as you know. It mentions critical industries. And my understanding is that there was very much the intent to protect the aerospace supply chain in that provision for, if you will, direct grants with conditions. In addition, there is a small business lending facility that's gone live on Friday. I mentioned earlier that any small business has the right to apply to a 2-year forgivable loan if you keep your payroll. And we will be rolling out in the next couple of weeks a Main Street lending facility, which the terms are complicated, but we've got to figure that out. And a corporate lending facility for people who access the corporate market. So there will be lending facilities out there. I mean, the fundamental though, right? I don't know how many, if I remember correctly, Boeing had a year and a half ago, like a 7 or 8 year backlog of planes and plane orders, which meant that you could lay out beautifully a supply chain. You could nurture all these suppliers. You could convince them they had 7 or 8 years of thing. That's just not where we are today. Now, I don't know how much that backlog has been cut back for the 737 MAX problems. I don't know how much the backlog's been cut back because of the airline industry's problems, but it's got to be a lot. And Boeing itself, in January, I think, cut back its production, having maintained inventory for all of 2018. And so you've got a bunch of guys who are struggling right now. And I don't know if you brought back their employees exactly what you do. I guess it's Spirit Aerospace, which laid them all off in January. I guess you get them working on building inventory, hoping that Boeing's going to order something in the future. It didn't work out well. So I think it's a real challenge, but it's an end-to-end challenge for sure.
Right. I guess it goes back to your first point, right? If people aren't comfortable flying, then like nothing else after that works. So
yeah, I think the human beings have a really hard time of seeing massively discontinuous futures. And I would count myself, you'll be glad to know, as a human being. I do too. So I can see airlines flying a year from now because I believe there'll be a vaccine or a treatment. But if you told me there's going to be no vaccine or treatment, and you as a guy who's going to get older and in a year and a half is going to be in that 60 plus category, you're going to have to decide whether you want to fly. I mean, you can imagine maybe we need hermetically sealed cabins, a 1-by-1 boarding process. I don't know, but it doesn't feel nearly as efficient as the industry was, a month and a half ago.
Yeah, well, I'll start designing that. So thank you.
Yeah, I'm glad you are.
Well, in the essence of time, it looks like we're approaching our last question. So Tom, thank you so much. I know we've been firing away at you, but this has been some really great discussion. So I appreciate all of your candor and comments and knowledge that you've been sharing with us. And I'm going to throw it to Matthew Arnold for our last question.
Hey, Tom, thanks for being with us. I'd be curious to hear your thoughts on the current level of corporate debt and maybe what the associated risks are from your perspective.
Well, it's high. I mean, corporate debt as a percent of GDP is higher than it's ever been. I had the CEO of one Fortune 20 company tell me, I have 180 billion in debt, but God, the rates are so low, I can't afford not to. He hasn't called me in the last 3 weeks. I'm just hoping he's okay. Debt is one of those things. It's, I'd say the economy runs in cycles for a reason. And it runs in cycles because memory is only so long. In my own firm, we had a recession every 8 years. 8 years is because that's how long it took the new management team to decide that the old management team didn't really know what they were doing and we knew better than they did. And then we would go off a cliff again. I think that's why markets crash every 40 years, et cetera, et cetera. So, the good thing about debt is it's relatively cheap compared to equity, and it helps fund a lot of growth. The bad thing about debt is when the growth disappears, you end up holding the bag. I was a CFO of McKinsey for a while, so I've thought about this in that context. But if you're a CFO, part of your job is to make sure that your current vulnerability is always low, that you're ahead of the market and refinancing things well before it comes due. And I think, and you have to avoid the temptation to juice your returns by taking on too much risk. And so what you've seen in the last month is high yield spreads gap massively. You will see a lot of oil and gas drillers and producers going bankrupt, I think, to be sure. you'll see a lot of retailers going bankrupt. I can't believe JCPenney and Bed Bath and Beyond have a future in a world where you're increasingly comfortable buying stuff online, and they're not nearly as relevant from a retail standpoint as they used to be. And so you'll see a lot of high yield shake out. And then I think a generation that goes through this kind of debt crunch will be a little more cautious for a while. As I think I said earlier, we never make the same mistake twice in a row. The problem we're going to have this time is not collateralized mortgage obligations and people putting too much in. It's just not this problem. It'll be another problem. And I think there's a good chance corporate debt will be this problem. By the way, PE firms are going to be working hard to work out of this, and we'll see how well they do. All that said, there'll be another generation, and people will invest, and eventually people will take on excess debt again. I worry more about the implications of the restructuring. So the banks, how exposed are they? Do they have enough capital? I think so, but that's something we watch very carefully. I worry about the employees in firms that are over-levered, that are going to get laid off, that wouldn't get laid off if they weren't over-levered. And I worry about some of the short-term decisions taken by a bunch of these companies to sort of manage their cash flow rather than think about their growth and what will that do for the economy. So you'll see an impact of this over-levering, I think, in all three dimensions.
Thank you.
Thank you.
So I'm going to jump back in and just offer my sincere appreciation for the hour and a half of questions and answers. And I just want you to know that you were so good, even a marketing professor could follow most of it. So it was fascinating. So thank you very much. I want to just publicly recognize Dr. Travis Box that sent some material out to our students. And I hope, Tom, that you enjoyed it, and someday you'll consider doing this again.